You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and welcome to 2022, the time that taper forgot. Well, we'll see if that happens or not. And with us is our good friend, financial expert, David Scranton. David, Happy New Year and Happy
New Year.
Thanks.
Yes, yes.
Taper, tightening. Is it real or is it Memorex?
Well, it's real. The question is, to what extent will they be able to tighten? And, the pressure, as you know, Kerry, comes from what we're seeing right now in inflation. And those numbers throughout this year, 2021, this past year, have been really, really high. So everyone's pushing them to taper so that we can kind of stave off inflation. What I think people are forgetting, though, is that inflation comes from two sides. It's an increase in demand for goods and services and a decrease in supply. And whenever you raise rates, the whole idea is to slow the demand down. So in a normal high inflationary environment, it's all coming from the demand side, or most of it's coming from the demand side. So demand is so high, it's pushing prices up that if you taper and you push the demand down a little bit, you can still have a growing economy. Right now, because it's coming from both sides, it's not just the demand side. I'm afraid that they taper, it pushes the demand down too far, and then we end up with essentially a Fed-triggered recession. So what I'm really hoping is they get the supply side figured out, because that will solve more than half of the inflation problem in and of itself.
Well, it's an interesting phenomenon because during the government's response, worldwide government response to the pandemic, we got increased money supplies, increased printing of currency units, and we had decline in production. And if you just say we lost 2-3 months of production, a quarter, you got just-in-time inventory, you got lean inventories that companies keep, like your average supermarket's 3 days till the shelves are empty. So we really got the worst of all possible worlds, don't we?
We do. And, I certainly, wouldn't want to be Jerome Powell right now, because he is going to have to walk a tightrope. If I were him, and I'm glad at this particular stage I'm not, I'd rather be him when the job's easy than when the job's difficult like this.
Yeah.
But and it's always easy from the cheap seats. But I think what's most important is they get long-term interest rates to rise first before they start raising short-term rates. And that may or may not work. When they talked about backing out of quantitative easing to let long-term rates go up, literally the meeting ended, and what happened to long-term interest rates? They went back down again. So the market is saying that it's going to be resistant to allowing long-term rates to float up. So let's say that the Fed quits, they stop quantitative easing, and long-term rates don't go up. Long-term rates have to go up to allow them to raise short-term rates, or you have the dreaded flat yield curve, right, which nobody wants. So then what else might they have to do? Well, now they might have to tighten quantitatively. In other words, start to sell some of those bonds off their balance sheet, which, if you remember, they did that into 2018. And it worked for a couple of quarters. And then all of a sudden, in the last quarter of 2018, they tried to do it one more time. And the bond market had a tantrum. And long-term rates came slamming back down. And the Fed had to stop its easing efforts. So that's my biggest concern. Can they really drive long-term rates up when there's so much money out there, such a big demand for both stocks and bonds and everything? Because if they can't, then they really shouldn't be raising short-term rates either, in which case they could possibly be handcuffed by the financial markets.
Well, inflation, according to some authorities, is going over 10%. If they don't, you've got these huge, historically high negative interest rates, negative real interest rates. That is destructive to the economy long term. So you can't raise rates, and the market goes crazy if you do. But if you don't raise them, what's going to happen then? You're going to have all these malinvestment, misallocation of funds. And where does that leave you?
Right, because you're right. All this cheap money that's floating around has to go somewhere. And that's part of what's creating inflation. But it's also a big part of what's creating asset inflation now. Real estate prices going crazy in many parts of the country, especially where I am in southern Florida.
Mm-hmm.
Stock market values continuing to go up, and even bond prices going up. So that's, it's all that money going into assets like even bonds that's going to make it really difficult for the Fed to raise long-term rates. So to me, I think it's more of a political issue. If you can focus on fixing the supply chain problems in any way possible, and I don't even begin to pretend that I know how to do that, Kerry. So don't ask me about that, please. But if they can do that, then I think, as I said, that'll solve half the inflation problem. And if inflation, even by those higher estimates, goes from above 10 down to maybe 4 or 5, then I think everyone could live with that with a reasonably strong economy. That's really what they have to do first. And I'm afraid they're going to go to the demand side first and create that recession.
Yeah, well, I don't think they have any easy way out of this. Yeah. You can't leave rates at negative because it turns a nation of savers into a nation of borrowers. We're already having, awful savings rates. Yes, it went up during the pandemic because nobody could buy, but I venture to say our savings rate is probably negative. And then when you see that everything's getting more expensive, you don't want to hold the cash. You want to hold goods. You want to get rid of the cash as soon as you can. And then you get that so-called crack up boom.
Mm-hmm. It's funny. I'm a flight instructor, very part-time. And I had a student come in who owned a small airline over in, I can't remember which one, but one of the ex-Eastern Bloc type countries. And we're talking about negative interest rates in his country. And he said to me that, and we talked about how easy it is to borrow. And he said, yes, I go buy a used 737 and I could borrow money, for a fraction of a percent. He said, but then the problem is when I want to take money and I want to put it in the bank, I owe them money. He said, so it almost forces me to go out and buy more aircraft and borrow more money and try to put it to use in some way, shape, or form. But Kerry, I believe that there's almost no turning back from that. To turn back from that, we would have to go through a pretty prolonged period of economic pain. And whereas you can argue that might be the better answer long-term for a country, politicians have no penchant for going through a lot of long-term economic pain. So I actually wrote in a newsletter to clients back in 2008, May of 2008. I said, I think we're going to become the next Japan with negative interest rates. I saw that trend starting.
Sure.
And frankly, it's continued to go on since 2008. And remember a minute ago, I talked about what happened in 2018 when the Fed tried to raise rates in a healthy economy. And the bond market basically stopped it. And they forced long-term interest rates back down again. And the Fed could no longer raise rates. That's the environment we're in right now. And I don't think that's going to change. So whereas I agree that you want to have more savings and not a nation of spenders and borrowers, I think it's almost too late. In many ways, the toothpaste is already out of the tube, I think.
So we're just going to have these artificially low rates, and whatever happens, happens. Is that the deal?
Don't just survive, thrive. The Financial Survival Network.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700-ton-per-day mill with an 8-million-ton tailings facility ready to be used. There is already power to site and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year or over 60 million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, I mean, and think about from the government standpoint, right now with all the national debt, especially if, the Build Back Better plan goes through and there's another $3 trillion, just pouring a little more salt in the wound.
Build Back Broke, was that the one you're talking about?
Yeah, yeah, that one, exactly. But even without that, though, it's still, we have so much debt now that the government really, and most of the Western world can't really allow interest rates to go back up because they can't afford to service their own debt. So everyone is always worried about the world, who's going to become the world reserve currency. Well, maybe China will. Well, now China is going through this property debacle. Not to mention, maybe the lack of trust factor that a lot of the Western world might have with appointing China's currency as the world reserve currency. But now with the real estate issues they're going through, it makes it even worse. So yeah, I think what it comes down to is if the whole world is in the same boat, it almost doesn't make a difference because one country is not worse off relative to the other. And I think that's where we're headed, like it or not.
So if we're in the new norm boat and that boat's sinking, then we'll all go down the drain together. Is that it?
Yeah, I mean, well, think about the problem with devaluation of currency, right? As you know, and hopefully a lot of your listeners know, is that typically speaking, when you have inflation, it's not that prices are going up, it's that your currency is getting devalued. So it takes more units of your currency to buy goods and services. But the assumption there is it's happening in a few countries, and other countries, it's not happening there. So as a result, you get, it affects you with imports more than it does with domestic goods and services. But if all countries are going through that at the same time, and they're going through a devaluation of currency, then again, it becomes a wash. It's almost like if all of us defaulted on our debt to each other. If every country defaulted on its debt to each other and everybody wrote it off, we'd all be back to square one again. So I can't imagine how else it would play out when you have most of the world in the same boat right now.
Yeah, well, something's got to give here, David.
Yeah.
Trend in motion stays in motion until it stops. And the trend is your friend, except at the end, right?
Yep. I like that. Yeah, I hope you don't mind if I borrow that. The trend is your friend until the end. I like it. Thank you.
Just give that credit to Nick Santiago. Okay.
There you go.
Got it from. All right.
There you go. Great. Well, it's the good news for the financial markets, at least short term, Kerry, is this. I believe that as long as the Fed doesn't make a major mistake, there's nothing out there that I can see. And I know it's always a sucker's bet to say, well, I can't see what's going to cause the market to have a major drop because most people didn't foresee the financial crisis in 2008 or COVID in 2020. But even though it's a sucker thing to say, I'm going to say it that I don't really see anything right now other than a Fed mistake that could really knock the market off its perch, because in low interest rates, securities mathematically are valued at a higher level and the economy is reasonably healthy. So people are worried about what Omicron could do to the stock market. And I'm saying, well, to me, the bigger concern is the Fed, hoping that they get it straight and watching them closely.
Yeesh. Oh, we have to rely on the Fed. All right. Well, you're just a burgeoning fountain of hope for the coming year, David. But like Eisenhower.
Why not? It's only the beginning of January. You have to be hopeful this early in the year, right?
Well, Eisenhower once said things are more like they are now than they've ever been before, and certainly they are now. Well,
right.
When I'm talking to you next January, market going to be higher, lower, same, cease to exist? Where are we going to be?
I think it's more likely it's going to be higher. My one big caveat is what I said about the Federal Reserve. That's the one big caveat. They raise rates too much, too fast, and kill all the excess demand. That's still not going to solve the inflation problem because of supply chain issues, but it could cause a recession. So 70% higher, 30% lower, and that 30% is resting squarely on the shoulders of Jerome Powell and company.
All right. Well, I guess it's going to be an interesting year. Hey, one other thing I want to comment. It used to be the Fed had two conflicting responsibilities. Number one was to assure that prices remain stable, whatever that is. In other words, no inflation. And number two was that we get as close to full employment as possible. And those two goals are virtually impossible. Now they've gotten a third area of responsibility, and that is to ensure that the stock market never goes down. This is impossible. This is a fool's errand, David. Really, there's no way to. This is worse than the seal balancing, juggling 20 balls on its nose. It just can't be done.
Yeah. It's true. And in most valuations, so now that I've been optimistic, let me give you the pessimistic side, Kerry. If you're investing in a company where you have minority interest, usually you're looking at a 40% discount. Okay, so if we had a $10 million company you and I were buying, and you were buying 51%, now we're buying 49%. I wouldn't be putting up 4.9 million to your 5.1. It would probably be closer to you're putting up 6 million and I'm putting up 4. You're putting up 6.5. I'm putting up 3.5. Because at 49%, I have zero control over the outcome of the company. There's usually that big of a discount. But in the stock market, that doesn't happen, because when companies get bought out, majority interest in a tender offer, it's never at that high of a premium relative to the market price. It's usually maybe a 10 or 15% premium, which means that as minority investors, we have been brainwashed into really, as far as the stock market's concerned, overpaying for an interest in which we have no control compared to those who do have control. So in some ways, it's become a bit of a Ponzi scheme. But you know what? It's a Ponzi scheme that's here to stay. Why? Because right now, everyone's retirement is based upon it. If the stock market drops and 401k values drop and IRA values drop, think about what the government would have to do for people to survive financially. Right now, they need to keep things propped up just so that people can afford to retire at some point. And you need people to retire, because otherwise you can't keep, as more people come into the workforce, you can't keep employment low if there aren't people coming out of the workforce on the tail end. So unfortunately, it's become a necessary evil that the Federal Reserve government has that axe to grind. And you're right, it's become a de facto third mandate, unfortunately.
All right. Well, I guess we are going to see how this thing is going to work out, how this massive science experiment is really going to work. And it's pretty exciting. David, if people want to get in contact with you, talk to you over the internets, how do you do that?
Best thing is to go to soundincomestrategies.com. It's our company, soundincomestrategies.com, and they can reach out to us there. Love to chat with somebody and give them more views if that's something that's of interest.
All right, excellent. And if you got a question for David, just shoot me an email, kl@kerrylutz.com. And don't forget, sign up for our free newsletter, financialsurvivalnetwork.com. David, we'll talk to you in the next quarter and see how things are progressing or regressing. You be well. Happy 2022.
Kerry, you too. My pleasure as usual. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.